The largest initial public offering in history is launching now, and for the first time at this scale, a rocket company is reserving 30% of the offering specifically for retail investors. They are targeting a valuation of $1.75 trillion. To put that in perspective, this single company is valued higher than the entire GDP of countries like Australia or Spain. This chart compares the $75 billion capital raise against the previous record holder. SpaceX is looking to more than double the largest IPO ever recorded. That previous record was held by Saudi Aramco, the national oil company of an entire kingdom, which raised $29.4 billion in 2019. The valuation is driven by a dominant hold on orbital launch. In 2025, the company accounted for roughly half of every orbital launch on the planet. While rockets are the public face, the profit engine is Starlink, their satellite internet division. It operates with a 60% adjusted EBITDA margin, matching the profitability of high-end software firms. These business fundamentals are exceptionally strong. However, the actual danger to your money lies in the mechanics of how the stock is sold on day one. Historically, the IPO process favors institutional insiders. Investment banks typically allocate 90% of shares to hedge funds and pension giants before the public can even place an order. This creates a hype tax. When the ticker goes live on a retail app, you are often paying a steep premium driven by media frenzy rather than the company's mathematical value. Mega IPOs frequently follow a predictable trajectory, a peak of emotional buying on the first day, followed by a significant drop in the following months. Success in this market depends on identifying the specific investment route that bypasses the emotional hype tax. This matrix tracks your 4 available routes into this deal. Route 1 is the IPO allocation, where you request shares at the $135 institutional price. You can submit an indication of interest through several retail brokers, but the barrier is higher than it looks. Because demand is so high, orders are usually severely prorated. You might request $1,000 in shares and receive only $50, effectively just the crumbs of the deal. Route 2 involves buying the stock on the open market the morning it debuts. This is a pop and sag scenario. Enthusiastic buyers often bid the price up in the first few hours, leaving those early investors underwater when the stock eventually corrects toward its fair value. Independent research from Morningstar currently pegs the company's fair value at $780 billion, less than half of the $1.75 trillion IPO target. Routes 1 and 2 offer immediate participation, but they carry a high probability of destroying capital by buying at the absolute peak of the cycle. Route 3 bypasses the public market entirely by purchasing insider shares through secondary platforms. This route is blocked by the accredited investor rule. To participate, the SEC requires an annual income over $200,000 or a net worth exceeding $1 million. Even for those who qualify, pricing is opaque. You pay heavy management fees and invest through complex vehicles, rather than owning the stock directly. For the vast majority of retail investors, this door is legally closed. Route 4 uses proxy investing, starting with closed-end funds that hold private shares. This chart shows the danger of a fund's market price detaching from its actual assets. Investors have paid $60 for shares that only hold $20 in underlying value. When the enthusiasm premium inevitably collapses back to the real asset value, investors take a massive loss, regardless of the company's success. A cleaner proxy exists: Alphabet, the parent company of Google. Alphabet owns roughly 5 to 6% of the rocket company, a stake worth approximately $100 billion. Buying the conglomerate proxy eliminates the hype-driven premium and the NAV trap, while still providing exposure to the company's growth. The most critical structural constraint on the stock price is the lockup expiration. Early employees are legally barred from selling their shares for 180 days after the IPO. This restriction artificially limits the supply of stock on the market. When that lockup expires in December, a massive flood of new supply hits the market. This forces the valuation down to a more sustainable level. Choosing to wait for the lockup is a structural strategy to acquire shares at a normalized price. This flowchart tracks constraints across budget, risk, and patience. If you struggle with FOMO, avoid day one and use dollar-cost averaging after the lockup. For smaller budgets, use fractional shares for a 1% position. Pragmatic investors should choose the tech proxy. Matching capital constraints to the correct route is the only way to reliably navigate this IPO. We are looking at a dominant, generational monopoly, currently wrapped in an incredibly expensive and deficit-heavy IPO structure. Expect a surge of scammers offering fake pre-IPO access or tokenized crypto projects. All legitimate access must go through registered, reputable brokerages. A disciplined investor simply watches the day-one frenzy unfold from afar without participating, choosing instead to prioritize math over momentum. Building wealth from an event like this requires a disciplined execution of market mechanics over several years.